This video is not going to tell you which coin is about to 10x. It is not going to give you a secret trading signal or a price prediction with a rocket emoji attached to it. Because here's the thing that took most successful crypto investors years to figure out, and that most crypto content will never say directly because it is not exciting enough to go viral. The path from $0 to $1 million in this market is not built on finding the right coin at the right moment. It is built on 3 specific habits that almost nobody in this space consistently practices, and that the data shows clearly and repeatedly produce better results than any trading strategy, any influencer call, or any attempt to time the market. 3 habits, that is it. Not 100 rules, not a complicated system. 3 habits that work together like a machine. And by the end of this video, you will understand exactly what they are, why they work, and how to build them into your investing life starting today. Let's start with the context, because the context is the most important thing I can give you before we get into the habits themselves. From 2014 to 2024, Bitcoin averaged a 54% annualized return, outperforming every major asset class by a wide margin, according to BlackRock's own calculations published in June of 2025. Not every year. Some years were catastrophic. Bitcoin crashed over 80% in 2018. It crashed over 60% in 2022. It has tested the conviction of every single person who has ever held it, but averaged across the full decade 54% per year. For context, the S&P 500 averages 11.5% annually over its long history. That gap between 11.5 and 54 is the opportunity. And the question is not whether the opportunity exists. The data confirms it does. The question is whether you have the habits to capture it without getting shaken out, tricked out, or traded out of your position before the return arrives. Habit 1. Dollar cost averaging, and the specific, counterintuitive way to make it work harder than almost anyone does. Dollar cost averaging means investing a fixed amount of money at regular intervals regardless of what the price is doing. Not when it feels right, not when the chart looks promising. Every week or every month on a schedule, the same amount, automatically, no exceptions. This is not a new idea. Institutional investors have used it for decades. But in crypto, where the volatility is dramatically higher than any traditional market, the data on what it actually produces is genuinely staggering. Investing just $10 every single week in Bitcoin from 2019 to 2024, a total investment of $2,610, produced a 202% return. That $10 weekly investment turned $2,610 into $7,913. Over the same period, gold returned 34% and the Dow Jones returned 23%. Bitcoin DCA beat both of them on the same invested capital, from a $10 weekly investment. The reason is structural. When you buy on a fixed schedule, regardless of price, you automatically buy more Bitcoin when the price is low and less when the price is high. You do not need to make any decisions. The math does it for you. You accumulate more units during the bear markets when everyone else is panicking and selling, and your average cost stays lower than any single entry point you could have chosen by trying to time the market. But here is where it gets even more interesting, because the data on what happens when you lean harder into the habit during periods of extreme fear is one of the most significant findings in crypto investing research published in 2026. Bitcoin Magazine Pro analyzed a modified DCA strategy, one that systematically increases the purchase amount when the fear and greed index drops below certain thresholds, and the results were remarkable. A fear-based contrarian DCA from 2018 to 2025 returned 1,145%, beating standard buy and hold by 99 percentage points. Why? Because the moments when crypto feels the most terrifying, when the index hits 10 or below, when the forums are full of despair, when influencers are posting screenshots of their losses, are statistically the moments that precede the largest recoveries. When the fear and greed index drops below 10, the subsequent 12-month returns have historically averaged between 150 and 200%. Not always, but with enough historical consistency that the pattern is documentable and actionable. Right now, in March of 2026, the Fear and Greed Index is sitting at 21, the second lowest reading in 18 months.
The DCA machine does not care. It buys anyway, and the people running that machine consistently, regardless of how they feel about the market in any given week, are the ones building positions that compound into life-changing wealth over time. One more specific data point on the mechanics of DCA that most people never hear. 7 years of backtesting from 2018 to 2025 shows that buying on Mondays accumulated 14.36% more Bitcoin than purchases made on other weekdays. Not because of any mystical property of Mondays, because Monday prices have historically been slightly lower due to lower weekend trading volume, creating a mild but consistent price pattern. It's a small edge, but compounded over years of weekly purchases, it adds up to a meaningful difference in total Bitcoin accumulated for the same invested capital. Set your DCA schedule. Set it to Monday if possible. Automate it and then leave it alone. Habit 2. Deep research before you buy, and the specific framework that separates the positions that compound from the ones that go to zero. Dollar cost averaging is the engine, but it needs fuel, and the fuel is knowing what you own well enough to hold it through the volatility without flinching. Because here is the brutal reality of DCA in a market with over 17,000 cryptocurrencies in existence. If you are dollar cost averaging into the wrong asset, something with broken tokenomics, no genuine adoption, a vesting schedule that creates constant sell pressure, then all the discipline in the world just produces consistent losses at regular intervals. The habit of deep research before you commit any capital is the filter that makes the engine worth running. So what does deep research actually mean in practice? Not reading Twitter threads, not watching YouTube videos about which coin is going to pump. It means answering 5 specific questions about every asset before you buy a single dollar of it. 1. What does this network actually do and who is paying to use it right now? Not who might use it someday, who is using it today in a verifiable on-chain way. 2. What is the total token supply, what percentage is currently circulating, and how much more is coming to market in the next 12 months through vesting unlocks or ongoing emissions? 3. Who built this and what is their track record? Anonymous founding teams with no accountability are a flag. Known builders with documented previous work are a signal. 4. What does the on-chain data show for actual usage? Daily active addresses, transaction volume, total value locked, developer activity on GitHub. These numbers cannot be faked the way marketing materials can be. Tools like Glassnode and Santiment make this data accessible to anyone. 5. What is the specific catalyst that would cause this asset's price to reflect its utility? And is that catalyst realistic within your holding timeframe? The assets that pass all 5 questions form a short list, not 17,000 coins, not 100, a short list of 3 to 7 positions that you can monitor intelligently, hold with genuine conviction, and build over years without second-guessing every price movement. Strategy, formerly MicroStrategy, has accumulated 717,722 Bitcoin using a systematic DCA strategy with an average purchase price of $76,020 through $54.56 billion in purchases as of early 2026. They're not diversified across hundreds of coins. They did deep research, arrived at a conviction, and then executed the DCA habit with institutional scale and discipline. The research habit is what made the DCA habit worth running at all. And here is the specific on-chain framework that professional crypto analysts use right now that most retail investors have never heard of. There are 4 metrics that institutional crypto analysts track as primary signals of genuine value versus speculative froth. MVRV ratio, which compares Bitcoin's market value to the total cost basis of all coins in circulation and signals whether the market is overvalued or in an opportunity zone. SOPR, the spent output profit ratio, which measures whether coins being moved are in profit or at a loss and signals whether the market is in a capitulation or a recovery phase. Exchange reserves, the total amount of Bitcoin sitting on centralized exchanges available for sale, which when falling signals accumulation and when rising signals potential sell pressure, and developer activity, the volume of code commits and pull requests on a project's GitHub repository, which is the single hardest metric to fake and the most reliable long-term signal of whether a project is actively building or quietly abandoning. When MVRV is below 1, SOPR is below 1, exchange reserves are falling, and developer activity is rising, that combination has historically represented the best accumulation windows in the entire history of crypto. The research habit means you know when those conditions exist, and the DCA habit means you're already buying when they do. Habit 3. Self-custody, protecting what you build with the same seriousness that you build it. This is the habit that most people skip, not because they don't understand it's important, but because it feels inconvenient, technical, and like something they'll get around to eventually. And then they don't get around to it, and eventually, in some cases, it costs them everything. The numbers on this are stark and recent. $2.37 billion in crypto was stolen in the first half of 2025 alone, a 66% surge over the same period the year before. Exchange hacks, phishing attacks,
SIM swapping, social engineering, the attack surface for crypto theft is enormous and growing, and every dollar of crypto sitting on a centralized exchange is crypto that you do not actually own in the full sense of the word. You own a claim, a promise from the exchange that when you want your coins, they will give them to you. FTX, which at its peak was the second largest crypto exchange in the world, trusted by millions of users, collapsed in November of 2022 and took billions of dollars of customer funds with it, not because of a hack, because of mismanagement, fraud, and the absence of any requirement to keep customer funds segregated. The people who had already moved their crypto to self-custody hardware wallets lost nothing. The people who trusted the exchange lost everything. Self-custody means moving your crypto off exchanges and onto a hardware wallet, a physical device that stores your private keys in an air-gapped environment that never exposes them to the internet. The hardware wallet market hit $560 million in 2025, growing because the losses from not using one kept accelerating. The two most widely used and audited hardware wallets are Ledger and Trezor. Both cost between $50 and $150. That is a one-time cost of under $150 to completely eliminate the single largest risk to your entire crypto portfolio, counterparty risk from a centralized exchange. The math on this is trivially simple. If you have built $1,000 in crypto through consistent DCA, a hardware wallet represents a 15% cost to protect it. If you have built $10,000, it is 1.5%. At $100,000, it is a rounding error. The cost of the hardware wallet does not scale with your portfolio, but the protection it provides does. And the habit of moving your coins to self-custody every time your exchange balance hits a meaningful threshold, say after every 10 purchases or once a month, builds a discipline around security that protects everything the other two habits are building. There is one more element to self-custody that goes beyond security and into something more psychologically powerful. When your crypto is on a hardware wallet sitting in a drawer, not a number on an app, not a balance you can tap to sell with 2 clicks, it changes your relationship with the position. It becomes harder to panic sell. It becomes harder to make impulsive decisions based on a 30-minute price drop. The friction of the hardware wallet is not just a security feature. It is a behavioral feature. It forces a gap between the emotional impulse to sell and the actual action of selling. And in a market as volatile as crypto, that gap is often the difference between keeping a position that compounds into wealth and exiting at the exact wrong moment because your phone made it too easy. So let's put the 3 habits together in the clearest possible terms. Habit 1, dollar cost average on a fixed schedule, increase the amount during extreme fear periods, buy on Mondays where possible, and automate it so the decision is never left to how you feel that week. Habit 2, before you start the DCA machine, do the deep research, answer the 5 questions, check the on-chain metrics, build a short list of 3 to 7 positions you understand well enough to hold through an 80% drawdown without selling. And habit 3, every time your exchange balance grows to a meaningful level, move it to a hardware wallet. Eliminate counterparty risk, use the friction as a psychological anchor against panic selling.
Now let's do the honest math, not the fantasy version, the real version. If you started a $250 weekly DCA in Bitcoin in January of 2024, a total investment of $67,500 over 2.5 years, at Bitcoin's current price around $71,000, your position would be worth approximately $120,000, a 76% return on invested capital. That is not $1 million, but here's the important part. That same study showed that at Bitcoin's October 2025 cycle peak of $126,000, that same DCA position was worth $208,000, more than 3 times the invested capital. The trajectory from $208,000 to $1 million over the next 1 to 2 full market cycles, with the DCA machine continuing to run and compound, is not a fantasy scenario. It is the extrapolation of a documented return pattern applied to a sustained, disciplined habit. The Esminston with Bitcoin research study, published in November 2025, concluded that even buying 20% above the then current price and exiting 20% below the projected 2035 median produced nearly 300% gains over a decade, with total savings reaching 7.7 times the initial capital. 7.7 times from a consistent DCA habit alone, without a single trading decision, without a single price movement prediction, without a single influencer call. Just the 3 habits, running consistently across time. The path from $0 to $1 million in crypto is not a secret. It is not a special coin or a special signal or a special moment. It is a machine, a boring, consistent, data-backed machine built from 3 habits that almost nobody practices with the discipline the data says they deserve. And the people who build that machine today, in March of 2026, with Bitcoin in a corrective phase and the Fear and Greed Index at 21, are the ones who will look back in 5 years and understand that the machine started during the fear, not the euphoria. That's when the compounding begins, right now. If this gave you a framework you can actually act on, smash that like button right now. This kind of grounded, data-driven content only reaches the people who need it when the algorithm sees it performing well. That like costs you nothing, and it directly helps. Subscribe if you want the analysis that tracks real crypto investing data, on-chain metrics, and documented strategies, not price predictions and hype cycles. Now here's your comment. Which one of these 3 habits are you the weakest at right now? DCA discipline, research depth, or self-custody? Be honest. Drop it below. The most honest answers build the best community. And if you know someone who has money sitting on an exchange right now without a hardware wallet, send them this video before the lesson costs them more than a ledger would have. Build the machine, run it consistently, and let time do the rest.